Silver got hammered in the paper market last night, but here's the twist. While the screen price was getting slapped around, the physical price in Asia was flirting with the $100 line, and within hours, a major bullion retailer quietly raised the drawbridge with a 5-figure minimum order. That's the event. That's the story. A paper smash, a physical premium, and a sudden, no small orders warning that tells you the squeeze is not a theory anymore. Now, before we go any deeper, I'm running a real campaign this year to push back on the copycat wave that's been ripping off original work. If you value the original breakdowns here, hit subscribe and drop OG John AG in the comments so the algorithm knows who's actually here for the real thing. And if you want the daily updates that don't always fit on YouTube, instant notes, quick voice updates, and the kind of personal analysis I won't post publicly, there's a WhatsApp channel link in the description. Join it, because when things move fast, that's where I can move faster. All right, let's rewind and walk through what happened, step by step, because the timeline matters. Yesterday evening, the price you see on the big quote screen started sliding hard. It wasn't a gentle pullback. It was the kind of move that makes you blink, refresh, and wonder if your feed is broken. Gold dipped, silver dipped harder, and the chatter immediately started. Is this the top? Is the run over? Did the market just flip? But then the other side of the world woke up. In China's physical exchange ecosystem, the benchmark spot silver price printed just a hair under $100 per troy ounce when converted. And that's before you account for the tax loadout effect that buyers there face when they actually pull metal out of the vault system. When you include that, the all-in physical number being paid for real deliverable silver was closer to the low 100s per ounce. Read that again. The paper market was panicking. The physical market was paying a premium that screams shortage. And this is the first major cliffhanger of the entire story. If the paper price is the price, why is the physical price in the largest manufacturing region on Earth trading in a different universe? That question matters because it leads to the second cliffhanger. If Asia is already paying triple digits for real silver, what happens when the rest of the world tries to catch up?
Now, I want you to keep two ideas in your head at the same time, because most people can't do that, and it's where they get trapped. 1. Retail demand. The small buyer walking into a shop does not set the global price by itself. 2. The physical market still tells the truth, especially when industrial buyers and large pools of capital are involved. So yes, your local coin shop isn't dictating the benchmark. But when the biggest physical hubs start paying more than the paper quote, that's the market whispering something you're supposed to ignore. And the mainstream will do everything they can to help you ignore it. They'll point to charts, they'll point to futures, they'll point to liquidity, and they'll say, see, it's down, the story is over. But the physical spread is the story. The physical spread is the stress test. The physical spread is the crack in the wall. Now let's talk about the paper side for a moment, because I want you to understand the mechanics without getting lost in the weeds. On the major U.S. futures exchange, the amount of silver traded in a single day was so absurd that if you convert it into ounces, it rivals or even exceeds annual global mine supply. In one day. Let that sink in. And here's the part that should make any normal person furious. Almost none of that is metal changing hands. It's contracts. It's leverage. It's a stack of promises piled on a very small base of real inventory. That isn't price discovery in the way most people imagine it. That's a paper system trying to manage optics while the physical system deals with reality. And reality is loud right now. Because while paper ounces were flying around like confetti, the physical supply chain was tightening. You can see it not just in Asia, but in the retail pipeline too. Go look at the premiums, not the spot quote, the premiums. A couple of years ago, you could pick up a standard government-minted coin with a small premium and feel like you were paying close enough. Now you're seeing 3-digit price tags for common retail items, and that gap isn't just dealer greed. It's a signal. A signal that inventory is scarce, replacement cost is rising, and delivery is uncertain. And if you think that's just small buyer drama, here comes the next data point that changes the mood entirely. One of the biggest bullion dealers in the industry rolled out a new rule, a $10,000 minimum order requirement on retail purchases. That is not normal. That is not business as usual. That is a company saying, in polite corporate language, we are overwhelmed, we are rationing flow, and we are protecting our pipeline. They also signaled shipping delays, product availability shrinking, and a shift toward focusing on a narrow set of items they can actually source and move reliably. If you've never seen a large dealer do that, you're not alone. It's rare, and it shows the stress is not imaginary. Now, I can already hear the counter-argument because it always shows up like clockwork. People will say, that's just demand, that's just hype, it will fade. Maybe, but here's what those people always forget. It doesn't take universal participation to break a tight market. Precious metals participation is historically tiny compared to the total pool of investable assets. If even a small slice of the public pivots into physical metals, it's not a gradual adjustment. It's a flood into a shallow pool, and silver is the shallowest pool of all. So the question isn't, will everyone buy silver? The real question is, how much money does it take to run into the ceiling? And that brings us to the next layer, the mainstream narrative. When major business networks start running segments openly talking about gold at 5,000 and silver at 100, that's not because you and I just discovered it yesterday. It's because the story is becoming impossible to hide. They'll wrap it in fancy language like resource nationalism, supply chain disruption, and geopolitical risk. And to be fair, those factors are real. Countries are fighting to control critical inputs. Export controls are increasing. Industrial consumption is not slowing down the way people assumed it would. But there's also a psychological factor. Mainstream coverage is a pipeline for mainstream money. For years, the average investor ignored metals because the media ignored metals. Now, if the media starts mentioning a target, even skeptically, it plants a seed. And seeds are dangerous in a market that is already structurally tight. Now, there was also a report carried by a metals news outlet quoting a major bank, Citibank, suggesting near-term targets around 5,000 for gold and 100 for silver within a short time window, while also warning about volatility and pullbacks afterward. Whether you love banks or hate them, their targets matter for one reason: they influence positioning. When a large institution publishes a framework, it can become self-reinforcing. Funds adjust, traders front-run, hedgers shift, and suddenly the move people thought was crazy becomes the move people fear missing. But let me be clear, a bank talking about higher prices does not mean they're on your side. Banks can be bullish and still be using that bullishness as a tool. They can draw in liquidity, shake out weak hands, and buy dips while retail is panicking. So when you hear 5,100, don't hear it as a promise. Hear it as a sign that the conversation has moved to a new level. And that level comes with one word: volatility. Last night's smash is the reminder. You're going to see spikes down. You're going to see violent reversals. You're going to see days where the market feels like it's trying to throw you off the ride. That's not proof the trend is dead. That's proof the game is changing. Now, here's a retention moment, because this is where most people miss the biggest clue hiding in plain sight. If the physical price in China is already higher, and if major dealers are already rationing, why did the paper price drop? Simple. The paper price can drop because paper can be printed faster than metal can be mined. The paper system can create supply by issuing more contracts. The physical system cannot create supply by writing a number on a screen. So the drop is not necessarily a reflection of abundance. It can be a reflection of leverage being used as a pressure valve. And that's why you have to watch the spread. Now let's talk about the silver mining side, because this is where things get even more interesting. Most investors look at miners and complain, why aren't they moving as fast as the metal? Sometimes that complaint is fair. Miners can lag for many reasons: costs, hedges, jurisdiction risk, dilution, management mistakes, and the simple fact that the market doesn't believe a price move will last. But if you look at average realized silver prices by quarter, you'll see something that should make you sit up. The average in mid-2025 was around the $40 region. Late 2025 averages jumped closer to $60, and early 2026 so far is printing averages north of $80. If that holds anywhere near these levels, the cash flow math for primary silver producers changes dramatically. It doesn't change a little, it changes a lot. That means earnings reports, especially the next few, could shock people who haven't updated their models. And when models get updated, valuation frameworks can snap into a new range. Now, will every miner benefit equally? No. Some will burn cash, some will struggle with energy costs, some will have political trouble, some will dilute shareholders to survive. But the sector as a whole tends to reprice when the market believes the metal price regime has shifted. And here's the next cliffhanger. If silver is already trading at triple digits in major physical hubs, what happens to miners priced as if silver is still 50? That gap is where the opportunity and the danger lives. Because repricing is not smooth, it's explosive. Now, zoom out with me to the macro picture, because this is the part that connects every record chart you've been seeing. Stocks at highs, homes at highs, metals at highs, industrial commodities at highs, debt at highs, money market balances at highs, government deficits at highs, household debt at highs. When everything is up at the same time, the lazy explanation is everything is booming. But the more honest explanation is that the measuring stick is shrinking. Fiat currency buys less. When the unit of account is being diluted, assets look like they are rising together because they are being repriced in a weaker yardstick. That doesn't mean every asset is equally attractive. It does mean the era of stable money is over, at least for now. And in that environment, Gold and silver don't need to become magical. They just need to be what they've always been, monetary metals that can't be printed. Now, before we go to the ending, I want to drop in something creative and quick because some of you love digging into real stories of people who actually made it. If you want silver-related success stories, real journeys, real lessons, real wins, there's a link in the description to another channel that focuses on exactly that. Subscribe over there too, because it's motivating to see what people pulled off when they understood the cycle early. All right, back to the main thread. We have 3 signals all flashing at once: paper volatility, physical premium, distribution stress. Any one of those alone would be interesting. All 3 together as a warning label. And the warning label is not run away. The warning label is pay attention because the next phase can move fast. Now I want you to engage with me on this because your answers tell me what the community is seeing on the ground. First question, are you noticing higher premiums or tighter availability where you live? Or is your local market still calm? Second question, do you think Asia is now setting the real price for silver? Or do you believe the paper market will keep control longer than people expect? Drop your answers below. I read them, and the best comments shape future videos. And while we're talking community, if any of you are doing well right now, business, investments, career, anything, share a win in the comments. It doesn't have to be a brag, it can be a lesson. Because when people see real progress, it raises the whole room's energy. Now, let me also be transparent about something that matters to the most dedicated viewers. By the time you're watching this, there's already a members-only video published that bundles the key updates in one place. If you want the clean, in-depth version without the noise, join the membership and watch that members-only upload. Premium members will also get deeper analysis as this story evolves, and honestly, it's the clearest way for me to see who is really following closely. And one more time, don't forget the WhatsApp channel in the description. That's where the instant updates go, including quick voice notes when headlines hit and charts change before the next YouTube upload. Now let me slow down for a moment and tell you what that move looked like as it unfolded, because the feel of it is part of the data. The selling didn't arrive politely. It hit like someone kicked the table. Silver dropped fast enough to trigger stops, to spook new buyers, and to force anyone who was leaning on leverage to make an ugly decision in real time. And that's always the danger with silver. It's not just a metal, it's a mood swing. But here's what changed the tone for me. The bounce started showing up almost immediately. Not a slow crawl, a snap. One of those rebounds where you watch the quote flicker and you realize the market is trying to shake people loose, not quietly rotate into weakness. The paper screen said panic, but the behavior said support. And if you've watched enough bull markets, you know the pattern. A strong trend often moves like a staircase with nasty steps. You get runs that feel unstoppable, then a sudden shove that makes the crowd doubt everything, then a recovery that makes the sellers regret their timing. It's how the market transfers metal and exposure from impatient hands to patient hands. So when someone asks, was last night bearish? My answer is, it depends on what happens next. Because one ugly candle doesn't define a trend. Structure defines a trend. And that brings us to a simple technical framework that helps you stay grounded without turning your brain into spaghetti. Over the last couple of months, silver has been tracing a rising channel. Picture 2 upward sloping lines, one acting as support underneath price and one acting as resistance overhead. Price has been bouncing between those rails. When we tagged the upper rail yesterday, we got rejected. That's normal. It's literally what resistance does. The question is not, did we get rejected? The question is, do we keep making higher lows after the rejection? Because if we do, the channel is still intact, and a breakout becomes more likely the more times price pressures that upper boundary. And here's the cliffhanger hiding inside the chart. If a physical market is already paying triple-digit effective prices, then the paper chart's upper rail may not be the ceiling at all. It may be the lid on a pressure cooker. Now, let's connect the chart to the physical reality, because this is where the story gets dangerous for anyone relying on paper optics. In the Shanghai physical ecosystem, the benchmark spot silver print converted to roughly $99.98 per ounce. That's the quoted number. But the quoted number is not the full story because of the value-added tax mechanism on loadout. Once you include the VAT impact, the effective cost to pull real silver out of that system was closer to $113 per ounce. So when the Western screen price was wobbling, the effective physical number in a major demand hub was sitting comfortably in the low 100s. That is not a rounding error. That is a signal. And signals like that matter because silver is not just an investment metal. It's a working metal. Industry consumes it. Supply chains depend on it. If the physical price is higher where manufacturing demand lives, that tells you where the real pressure is building. Now,
I want to say something that will offend some people, but it will save others from making emotional decisions. Retail demand, your personal coin purchase, does not single-handedly set the global benchmark. Retail matters, but it's not the engine by itself. The engine is industrial pull and large capital flows. That's why the East matters. China matters. India matters. And the broader manufacturing world matters, because that's where big, non-optional demand comes from. A manufacturer doesn't feel bearish about silver. They either have supply or they don't. They either lock inventory or they risk production. That's a different mentality than a trader staring at a 5-minute candle. Now, let's talk about the paper side with real numbers, because the scale is almost absurd. The futures exchange volume being discussed was around 1.27 billion ounces in a single day. 1.27 billion. Converted, that's roughly 40,000 metric tons worth of paper silver turning over in one session. That's around 1.5 times the world's annual mine supply, traded in a day, mostly without physical delivery. So what is that, if not metal changing hands? It's leverage. It's a claim system. It's a stack of promises. And here's the retention point that most people miss. If the paper system can trade that much silver and still can't eliminate physical premiums, then the physical market is telling you the paper system is not solving the underlying shortage. It's only painting over it. In other words, you can print paper ounces faster than you can mine real ounces, but you can't print your way out of actual physical demand. That's why I keep bringing you back to the same comparison, quote versus reality. And reality is showing up not only in Asia, but also in the retail pipeline, which acts like a visible thermometer for stress. Look at the premiums people are paying, not the spot quote, the premium. Standard products that used to trade with modest markups are now carrying price tags that feel almost unreal to anyone who hasn't been watching closely. 3-digit totals for common retail units, delays, out-of-stock banners, allocation limits. Again, retail isn't the global engine, but retail is the early warning siren. It's the part you can actually see. And that leads us straight into the biggest operational signal of the week. A major bullion dealer introduced a $10,000 minimum order requirement for retail purchases. That is not normal. That is not a sale. That is triage. That is a business saying, we are overwhelmed, our processing capacity has limits, and we need to reduce chaos. They also communicated longer ship windows, a narrower product focus, and constraints on pre-sales unless delivery can be reasonably guaranteed inside a tight time frame. If you've never seen a large dealer do that, it's because it doesn't happen in calm markets. Now, some people will try to wave this away with a simple line. It's just hype. But hype doesn't force operational rationing unless the order flow is real. And operational rationing is the kind of thing that, once it starts, can become contagious, because wholesalers and mints also manage allocation, and allocation pressure rolls downhill. Now, step back and ask the obvious question. If big dealers are throttling orders while Asia is paying a triple-digit all-in physical price, what happens if the mainstream public decides they want in? This is where the small numbers problem becomes explosive. Precious metals participation is still small relative to global investable assets. That means it doesn't take everyone to move the market. A small shift in allocation can represent a huge change in demand relative to available supply. If participation goes from tiny to less tiny, the move can be violent because the pool is shallow. Silver is the shallowest pool. Now, let's talk about the mainstream narrative shift, because this matters for flow. Major business outlets are now openly discussing scenarios with gold at $5,000 and silver at $100, using phrases like resource nationalism and geopolitical risk. They point to countries competing for critical inputs, to export controls, to supply chain friction, and to industrial usage that doesn't disappear just because a chart turns red for a day. And whether you love mainstream media or hate it, when they talk, it spreads awareness. Awareness is the gateway to participation. Participation is the gateway to pressure in a tight market. Now, there was also reporting circulating from metals news sources that a megabank, Citibank, has published a framework with near-term targets around $5,000 gold and $100 silver in an early 2026 window, while also warning about sharp corrections after the move. I'm not telling you that because banks are saints. I'm telling you because banks influence positioning. When a big institution puts a number on paper, it gives funds a narrative to justify allocations. It gives traders levels to front run. It gives the public a headline to repeat. And here's the part you need to stay smart about. Banks can be bullish and still be playing games. They can talk up targets and still benefit from volatility that shakes out weak hands. So don't worship targets. Use them as evidence that the conversation has shifted. Now, some institutional commentary also flagged a risk factor tied to policy outcomes.
tariffs, trade programs, and regulatory decisions that can trigger forced flows in certain products. If policy outcomes cause rapid outflows from a vehicle, you can see a tactical sell-off that spills into the broader metals complex. But even the cautious analysts often frame that scenario as a dip to buy within a larger bull trend because the drivers, tight physical availability, geopolitical strain, and monetary uncertainty, don't vanish overnight. Now let's talk about price discovery, because this is where the long-term story gets bigger than any one candle. For decades, the Western futures benchmark was treated like the official price. But in a world where physical demand is strongest in the East, where physical exchange infrastructure is active, and where industrial pull is massive, price discovery can migrate over time. It doesn't flip like a light switch. It shifts through repeated stress events. First, you see persistent physical premiums. Then, you see flows redirect. Then, you see local benchmarks matter more. Then, eventually, confidence in the paper benchmark weakens because it can't align, quote, with deliverability. We are not at the end of that process. But when you see an effective $113 physical number next to a very different paper print, you are watching that process in motion. Now, quick myth versus reality, because it helps you stay anchored. Myth: if the screen price drops, supply must be abundant. Reality: the screen can drop because paper claims expanded or because leveraged traders were forced to sell, not because physical supply improved. Myth: premiums are just greedy dealers. Reality: premiums can be replacement cost, allocation pressure, and delivery risk. Myth: if mainstream starts mentioning big targets, it's automatically too late. Reality: mainstream attention can arrive early in a participation cycle if the public is still underallocated. The key is how many people are actually positioned, not who wrote an article. Now let's go into miners for a bit, because the mining stocks are where a lot of you feel confused, disappointed, or impatient. Miners often lag metals because the market doesn't believe the move will last. Miners also carry business risk, costs, hedging, dilution, jurisdiction issues, and management execution. But if you look at average realized silver prices by quarter, the math starts to get dramatic. Mid-2025 averages were roughly in the $40 range. Late 2025 moved closer to $60, and early 2026 so far is printing averages north of $80. If a producer is selling into an $80+ environment after budgeting for much less, and if costs don't rise in perfect lockstep, margins expand fast. That can shock earnings. And earning shocks are what force model updates. Model updates are what trigger re-ratings. That's how miners can suddenly wake up. But again, miners are not silver. They are businesses. Treat them like businesses. Now, let me lighten the mood for 10 seconds, because this market can make you feel like you're staring into a blender. There's a clip going around of a person trying to stop a vehicle with pure stubbornness, and the vehicle just drags them along anyway. It's hilarious, but it's also a perfect picture of what it looks like when a big short position tries to halt a trend that is being supported by physical demand. For a while, the short looks in control because the quote can be pushed down. But if the underlying pressure is real, the trend keeps moving, and the short gets dragged. Now, zoom out again to the macro backdrop, because this is the piece that explains why you're seeing everything at highs all at once. Stocks high, homes high, commodities high, metals high, debt high, deficits high, household debt high, cash piles high. When everything rises together in fiat terms, it often means the measuring stick is shrinking. The currency buys less, so asset prices rise in that weaker unit. That doesn't mean every asset is equally good, but it does explain why hard assets keep catching a bid. In a debasement environment, people hunt for things that can't be printed. Debt is the accelerant. Deficits feed debt. Debt feeds interest costs. Interest costs feed larger deficits. Larger deficits increase the temptation to debase rather than endure political pain. That loop is why gold has always mattered. And when gold matters, silver often becomes the volatility amplifier. Now, here's what I'm watching next, and I want you to watch it with me. Watch the Asia physical premium. Does it stay elevated? Does it widen? Does it compress? Watch dealer behavior. Do minimums stay? Do product lists shrink? Do ship windows extend? Watch policy headlines. Export controls, tariffs, and regulatory surprises can move the physical flow. Watch participation. If mainstream money starts rotating in, the move can accelerate because the market is shallow. And watch the chart structure. Higher lows matter more than dramatic headlines. Now, here's the final cliffhanger before we return to the close. If every paper smash creates more physical buying, then eventually the paper sellers are feeding the very breakout they're trying to contain. That's how pressure cookers behave. They don't leak forever, they release. And when they release, it's not slow. All right, now we can return to the main thread and finish this story with a clean, strong close. And I want to be honest with you about something else that people don't talk about enough. The emotional whiplash is the feature, not the bug. If you come into silver expecting calm, you'll get punished. The market uses speed and violence to separate conviction from convenience. That's why the crowd shows up late, and it's why the crowd usually buys tops and sells bottoms. Not because they're stupid, but because they're human. So whatever your approach is, write it down. Decide what would actually change your mind. A lower physical premium for months? A clear return to surplus? A collapse in industrial demand? Those are thesis level changes. A red candle on a Thursday night is not. And if you're new here, this is the reason I keep repeating the basics, because the basics keep you alive. One more thing. Don't underestimate how quickly sentiment can flip once price tags become socially visible. When people start hearing $100 silver in casual conversation, that's when FOMO starts. And when FOMO starts in a thin market, things can gap, dealers can ration, and the paper price can chase the physical price instead of leading it. So here's my comment challenge for you today. If you had to pick one signal that matters most right now, what is it? Asia's physical premium, dealer rationing, or the insane paper volume? And second, if we do see another sharp pullback, are you treating it as a warning to run or a chance to add carefully? Answer those below, because your answers help me measure where the community's head is at. And yes, hit the like button too. Not for ego, purely for reach. If this breakdown helps you, it will help someone else who's still asleep. I keep a little silver bell on the desk, and every time we cross a big like milestone, I ring it as a reminder that this is bigger than one person watching a screen. It's a community paying attention while the story is still unfolding. If you're here early, you're already ahead. Don't waste that advantage today at all. Now, as we wrap up, I want to pull all of this into a single, simple takeaway. Last night was not nothing. Last night was a stress test. Paper prices tried to scare people out. Physical prices refused to comply. Dealers started rationing. Mainstream outlets started whispering targets they used to laugh at. And big banks started publishing numbers that would have sounded impossible not long ago. That combination is not normal. That combination is a signal that we're entering a phase where narratives will swing wildly, and the people who win will be the people who can think clearly while everyone else is reacting emotionally. So here's my request, short and direct. Subscribe, because this story is moving in real time. And if you want to support the campaign to keep original work alive, hit the comments with OG John AG. I'll see you in the next one. And until then, take care of yourself and take care of each other.